Welcome back, everybody. Look, we're really excited to get underway the first of our two roundtables with some of the world's leading digital asset portfolio managers. So again, the intent of the conference is to show allocators different ways of expressing views on digital asset markets. Clearly, the asset management, crypto asset management infrastructure is a key way to do that. So without further ado, let me pass over to Matt Toomey, who's going to run the panel. To you, Matt.
Great, thank you, Matt. And thank you, guys. Hello and welcome to the first of the Fund Managers Roundtable. My name is Matt Toomey, and I lead the Prime Brokerage Sales and Cap Intro team at OSL. It is my great pleasure today to welcome to the conference Avaneesh Acquilla, CIO at Arrano Capital, Bob Tucker, CEO and founding partner at TCM Capital, Julien, Guerrand, hedge fund manager at Kernel Capital, and Martin Baumann, co-founder and managing partner for CMCC Global and Liberty Bitcoin Fund. Welcome and thank you for joining us, gentlemen.
Thank you.
Thanks, Matt.
Just a quick point to the audience. We do have a question function on the right-hand side, so please do add in a question into the chat and we'll try to tackle them throughout the panel. But to start with, perhaps we can just have each of the panelists share a little bit about their background pre-jumping into the digital asset space, and also what you guys are doing at your respective firms and why you are doing it. To kick it off, perhaps let's start with Bob, my top left hand, and then we can go in clockwork order.
Thanks, Matt, and hi, everybody. My background is really in traditional banking, asset management, capital markets and so on. Originally CFO of a large futures and options brokerage in London, in fact. Then spent the better part of a decade with a large global hedge fund. Before then, getting back into global markets and then ultimately into the space where we're at. We're a team of predominantly capital markets experienced people, but then team very much with emerging programmers, crypto, enthusiasts and so on. We're running an institutional fund that is global by nature. It's Cayman-based, managed out of Australia, and I'm sure we'll talk a bit more about that as we get into it, Matt.
Av, if you want to go next, please.
Yeah, sure. So Arrano Capital is the blockchain arm for VentureSmart Asia Limited. We're licensed Type 149 in Hong Kong, regulated by the SFC. So I believe we were the first asset manager to get the digital asset license from the SFC last summer. We have a Bitcoin fund and we're just about to launch our actively managed product. My background is I did 7 years in equity research in London. I was at Goldman, then UBS, and then moved over to Hong Kong, where I worked at OSL Capital Management, where I was a PM, long-short PM covering the industrial sector. And then a brief stop over at Kinetic, which should be familiar to a lot of people who are in crypto, and then now at Arrano.
Thanks, mate. Martin.
So, okay. Hi, good morning. My background is I started off in investment banking back in Germany in mergers and acquisitions. Came to Asia around 8 years ago to become a group CFO of a fintech-focused investment group. Got into blockchain end of 2015. Got fascinated by it when I realized the potential. Actually, when I realized that this technology will be nothing less, in my view, than the next iteration of the internet. An internet that will facilitate the flow and movement of value as opposed to just information and data. When I realized that, I kind of sat down with my co-founder, Charlie, who has a deep technical background, and we decided to launch a fund in this space. So it was one of the first venture capital funds in Asia to entirely focus on blockchain technology. Today, we have offices in Toronto and in Hong Kong. We are regulated as a mutual fund in the Caymans. We run 4 funds currently, 3 digital asset funds that are thesis-driven and focused on what we term as core technical network infrastructure, smart contract protocols like Ethereum and competitors, to Ethereum, and we run the Liberty Bitcoin Fund, which is a single asset tracker fund for Bitcoin.
Hi, hello, I'm Julien. I'm the fund manager and the founder of Kernel Fund. So Kernel Fund is a high frequency quant regulated by the MAS in Singapore fund, and we purely focus on digital assets. And before digital asset, we were managing an equity index option systematic market making fund, regulated in MAS in Singapore as well for over 15 years. Why moving into crypto? Well, after in 2008, after maybe 6 years of extreme low volatility in traditional market, we discovered crypto, and we saw the volume grow and the volatility, and we thought it's a great opportunity. And that's where we decided to make the move from traditional to digital.
Great, thanks to you, gentlemen. Look, I was really excited about today. All of you have been participating in the market for the past couple of years, and obviously you've had experiences and very impressive experience in traditional finance. But it definitely feels like over the last 3 months, we have seen a secular shift in the market, and certainly how participants view this young asset class. It does feel like now it has become legitimized. Although to many, this is still very early, and for most institutional investors that are new to the space, they're looking to get more educated. What advice would you give to these institutional investors that are new to digital assets when they're looking to assess new managers? Perhaps let's start this time round. I'll pick on Martin to start with.
Okay, yeah, I think, well, good question. When assessing new managers, I think as always in investing, it's about experience and integrity of the investment managers, right? It's about the setup. I think it's important to do a bit of diligence on kind of processes and structures within the asset managers, whether they have professional custody solutions, whether they have fund administrators to do a proper accounting and NAV reporting and these type of things. So I think that's important, but equally it's important to assess whether these people, well, the fund manager has, like, what's their background within crypto, whether they're new to the space, and if so, what's their edge really, and how can they really create alpha? Because I think markets are moving very fast within crypto, right? And it's really about finding one that is just not riding the wave, but adding value somehow. Yeah.
Julien, do you want to go next, please?
Yeah, I mean, I agree with Martin. I think it's important to choose a good regulatory environment, but it's definitely not an easy process because also, you know, many people are making money during a bull market, but how to evaluate the sustainability of your strategy, you know, during the years and during the different market cycles. So I think it's ideally choosing a fund manager that have years experience trading. I mean, if possible, the crypto asset class, but also other asset class, and maybe look at their track record, long track record, how sustainable were their strategy during a bull market, bear market, and how do they have environment and market changing environment.
Perhaps we can go to Baumann and Avaneesh afterwards.
No, Joe, I would very much agree with what the other guys are saying. I think one of the resounding things is that managers shouldn't necessarily need to be looking to shoot the lights out in the space. I mean, there's a huge amount of volatility, and I'm sure we'll talk about vol again, but it's not a matter of shooting the lights out, it's about having solid foundations to the business. So the 5 things we always talk to managers about the safety and security, ensure that there's investment grade platform which have recognized everything about those providers. That the team is experienced, that they can bridge the gap between capital markets and where things are going digitally. But also have a proper understanding of risk management. Basic sound risk will understand, it's replicable, where the managers are likely to start admitting, and they won't be drifting from the style of their business, it says in the CAD, I guess. The 4th thing would be ease of access, but practically and legally, in terms of the registrar function, what sort of securities, if that's what it is, that investors want. And finally, it's fee-based competitive fees that managers are charging. So all of those have got to stack up. That's very much what we've been focused on.
Yeah, and just to sort of add to some of the comments we've had, develop some of those ideas. If we start with the team, what I think is important is, because this industry is quite fragmented at the moment, most managers are managing, fairly small AUM relative to like the traditional space, and so the team's got to be really committed to being in this area, right? And so I think that's very important because as a manager, you've got to really be able to run the business at a low AUM. We all hope that AUM grows quickly, but at the moment, it's pretty small. So I think that's quite an important point. With regard to the team as well, there's a lot of managers that don't have asset management experience, but have crypto experience. And there's managers who have asset management experience, but don't have crypto experience. So I think, finding a team that really has a knowledge base probably should be at the top of the list of priorities. Nuances in the space, some of that is captured by the regulator and who the manager is regulated by. But there's a lot of due diligence that needs to be done on the exposure to hot wallets, type of custodians that they're using, the types of exchanges that are being used, what's the due diligence process from the manager when they onboard those counterparties.
Great, thank you, gentlemen. Some really interesting points there. And Bob, you touched on volatility, which is obviously a topic that I wanted to discuss with the four of you today. We've seen recent reports from Fidelity and JP Morgan conducting surveys into digital assets. And the primary concern for institutional investors as they contemplate exposure or greater exposure to the space has been volatility. Definitely some concerns around regulatory environment uncertainty, but the main impediment, I think, still remains volatility. I'm curious to know, and perhaps we can start with Julien on this, how you look at this view, how you think about market volatility, diversification, and also the opportunities that this presents.
Well, I mean, for us, it's an easy question because we trade volatility. So our strategy is based on volatility. We thrive through high volatility and high volume market condition because we capture the volatility in market neutral. For us, maybe volume is the most important element in the success of a strategy. But I will say high volume, high volatility are the conditions that we are facing right now, and that's the best condition you can have for a systematic quant trading strategy. And we say high volume, low volatility is still okay, but obviously if you have no volume and no volatility, that's a bit of a concern. So for us, as long as we are extremely correlated to volatility. So as long as we have volatility, we really like those market conditions.
Bob, if you want to go next, and then we can go around in order.
Sure, Matt. Yeah, we feel that vol is very often misunderstood, and it's almost always perceived as being bad. You hear about volatility in the evening news, it's always talking about downside vol. And volatility itself is actually an important commodity. In any portfolio, uncorrelated volatility is actually essential. If you look at the structure of well-diversified, well-structured portfolio, it is important. And back in the funds world, where I spent quite a bit of my time, one of the first ways for a manager to be bumped out of a portfolio is if they weren't hitting the vol target. So it's really a matter of being able to size your positions, and that's both from the investor and from the portfolio manager's point of view, and then understanding the space. So we're not actually trading, as Julien mentioned, they're trading vol. We're not taking a slightly more fundamental, very quant-driven approach, merely rebalancing the portfolio on a less active basis once a month, our approach. But volatility, I think, is actually healthy, and that's what we've seen, and by and large, it's been a good thing across the space. But it is a matter of understanding the underlying assets and the correlation with other asset classes and how the portfolio is really constructed.
Yeah, and you know, from my point of view, obviously the volatility is very high in this space, and so linking this with the first question, when investors are looking at a manager, they really got to decide what strategy do they want to employ, what kind of volatility profile are they willing to accept. So, obviously Bitcoin is anywhere between 50 to 100 most of the time, which is super high. In our actively managed strategies, we're around 15 to 20, which is still around where the S&P is. So, high versus like equity, hedge funds, but not high versus crypto. And so I just think, I always, when I'm talking to investors, I always like to talk about digital assets as an allocation within a particular portfolio. So as Bob was mentioning, there's nothing wrong with volatility. It's actually quite complementary in a well-diversified portfolio. So we should just represent one small percentage of that overall sort of allocation.
Yeah, and on our side, we run venture capital strategies, thesis-driven, long only. So to give you a sense, we started Fund 1 when Ethereum was at $7 and Bitcoin at 350. So, and we're not a trading fund. We generally are thesis-driven and sit out volatility. So that can also be a strategy, right? We're not making use of volatility. We just see it as a natural feature in frontier markets that are with assets that are liquidly traded. Oftentimes, perhaps even too early to be traded on exchanges. If you think of like all of these kind of projects are really early stage technology projects, right? And many of them are traded actually too early. So in our view, we sit out volatility and are really in the space for several years. Yeah.
This ties in nicely with actually an audience question that's just come in from Mark, but thinking about volatility and a potential style drift or the difficulty of maintaining your target volatility, Avaneesh, as you're trying to deal with that, how do you stay within your targeted volatility levels?
Yeah, well, one of the challenges is 24/7 trading. So we have algorithmic rebalancing of the portfolio to make sure we're hedged. We're employing like a market neutral strategy, and I would say one of the encouraging things versus my days doing long short in the equity world is that when you get sell-offs in crypto, everything is super correlated because there's not a lot of long short money in the market. Actually, most of the money is like levered long, and so when you get these sell-offs, actually a long short strategy does give you a decent bit of protection. For example, March last year, the Bitcoin drawdown was like, I think 47%. We were only down like 4% during the same time. So and that's where sort of a balanced market neutral book I think can work in this space. There are some particular features like the 24/7 trading that you need to really look out for. But it's a different type, because all the trading is electronic. There's definitely tools that you can use that can help rebalance a portfolio in times of volatility.
Plus, Martin, if you want to tackle that again, and then we can go around and clockwise.
Sorry, me now?
To tackle that from how do you, I guess with your book being more directional, as you see great swings, bull or bear swings, is that a factor in terms of how you look to rebalance, or are you looking to just be in the position for a set period of time or a long period of time?
Yeah. So in our case, really, it is long positions until we have the view to stay within the projects until they reach their full potential. To give you a sense of Ethereum had huge swings over the last 3 years, right? Up to $1,000 in 2017, then back down to $80. But really, it is an early stage nascent frontier technology, and it's not anywhere near where its full potential is, right? We are thesis driven in the sense that we believe that Ethereum may well become this next backend technology for the next iteration of the internet, and if that becomes true, then this will be significantly larger than anything else. So in any valuation today. But having said that, what we do is we de-risk from time to time when we feel markets are getting too hot. or when we feel like, for example, Avaneesh just mentioned March last year, the 13th of March, when Bitcoin collapsed and all global equity and gold markets even collapsed. We were sitting at that point in time on 50% of cash and used that day to buy back in, right? That's so we are risk conscious, but we're not shorting. We are kind of pausing. That's what we from time to time do. Pausing, sitting back, sitting on US dollar, and wait to redeploy if things are getting too hot.
I mean, for us, it's very different kind of strategy because, as I explained before, we are completely market neutral at all time. And market goes down, markets go up. We don't really care. We make money on every single trade we do and every time window that we take. But obviously, when the market goes up a lot or market goes down a lot, that's where we perform the best. So, but by the nature of our strategy are extremely high frequency. So we don't carry market risk at any time. Our leverage is always around 1 at all time. So I think as long as you manage well your system risk and your market risk, which for us is extremely low due to the high frequency nature of our strategy, you just hope for more volatility in our case. So we have the opposite effect where we actually really like volatility, and that's where the strategy performs the best.
Yeah,
we saw many different kind of market cycle. We saw crash. We saw market go up by a lot. And I think that's why I said in the first question that when you assess a fund manager, you should look at his track record. And if you're looking for a market neutral strategy, you will look at his Sharpe ratio cycle. But as long as you have a strategy that takes very low market risk, you should be performing well during high volatility conditions.
And
I think
our approach is actually not dissimilar at all to what Martin mentioned, where we essentially have a fairly fundamental view on the markets. We are a long-only fund with the ability to go to cash. So we'll do pretty much as Martin mentioned. If we feel there's been some fundamental dislocation in the market, we will go to cash. But by and large, our investors are looking slightly longer term. They want to have some managed, sensible exposure in the space with core allocation, and then some rebalancing around that, some optionality, and so hopefully some intelligent allocations outside of the core Bitcoin and ETH type holdings. But I guess the main thing that we do to manage that and to be able to deal with situations as they come up is to have global coverage so that we can actually exit positions when we need to. We're not trapped in these positions. But essentially, we're looking to pretty much ride out the short-term noise as it may be.
Yeah, I agree with Julien's comment as well about not deploying leverage because there's so much volatility.
Yeah, exactly.
You should be able to generate enough alpha and even like have a conservative enough book where you can have like cash ready to deploy. Like the leverage would take it too far, I think, and so that's one way of managing the overall volatility.
Yeah, you've both spoken about risk and about 24/7 trading, and I know this will apply as each of you have slightly different strategies. Perhaps we can start with Julien in terms of the market structure of trying to run a market neutral book with 24/7 trading, and obviously the new digital asset ecosystem. So for investors who don't quite understand what that means, I'm just curious if you can give some color on that.
For me, right? I think 24/7 is definitely a challenge. I think I'm much more tired now than when I was working for a traditional asset. Maybe I'm just becoming older also, but I think important is for us is systematic trading. We do trade 24/7 quite a lot because we trade a high frequency strategy. But the most important is we are continuously monitoring exchanges, health and maintenance. So we have, and it was the same when we were trading option on the traditional market. We have sanity checks at different kind of levels, and then we stop the trading, cancel all the orders if we detect any error or suspicious activities from the exchanges. So exchange behavior is always monitored, and we have communication. Of course, we have communication channel with the exchanges. We have real-time automatic monitoring and closing position if necessary. And we have real-time reconciliation of position and balances. And we have a system of alert of risk metrics if the risk metrics exceed certain limits. But, as we discussed during the precedent question with Avaneesh as well, is I think as long as for us, as we trade market neutral strategy and we don't take any leverage, we don't have any market risk. So that's the way to manage the risk, is to manage your system risk by having sanity checks at really different level. You suspect something suspicious, you just stop the trading. You don't take any risk.
And Martin, from your fundamental perspective, I'm curious to know, as we're looking out over the horizon of the next sort of 12 months, 24 months, where do you see this fragmented market continuing, or do you see there's going to be proliferation, and what are some of the things that you're most excited about?
Yeah, look, we are most excited about actually smart contract protocols, and because we see them as the back end for this, actually the network infrastructure for this next era, let me call it next era of the internet, an internet to facilitate flow and movement of value. And all these big smart contract protocols, like things like Ethereum is upgrading to Ethereum 2.0, Solana is really now reaching thousands of transactions per second, Hashgraph. There are projects that are now reaching this next level. And if you think of the internet of the early days, the internet existed since really accessible to people since the late 80s, I believe, early 90s. But really only with the emergence of broadband, with its speed and scalability, we have seen this big explosion of websites on the internet. Before that, before broadband, there were literally no websites on the internet, or hardly any. And we believe the same to happen here within blockchain. Only through, there will be this broadband moment when smart contract protocols get this scalability problem solved. And that will be the enabler, the true enabler for actually applications to be hosted on those digital networks. And so that's what we're really most excited about on the technical infrastructure side. On the Bitcoin side, I mean, Bitcoin is a case on its own, right? It has many features very similar to gold. It is really perceived as a real asset. Bitcoin is a real asset these days, and it's not like it was 3-4 years ago. It's still some level of speculation in there, but it's becoming a real asset, and that's what exciting us as well, and a true hedge against the global declining economy, right?
Thanks, Matt. We'll throw that question open to the rest of you. So, Bob, as you're looking forward on the next 12 months, I guess from your seat, whether that's what's exciting you most?
I guess from looking ahead down the line, we're working with a number of large institutional allocators, investors. So I guess the fun part for us and the exciting opportunity really is to work with these guys as they get themselves up the curve. Everyone's wanting to learn now. So if we look at what's changed from a year ago, the level of inward inquiry we're getting, the interest in the space has changed dramatically. It's been said by many other people outside of this conference, and I'm sure today as well, but the risk has shifted on managers now, where not that long ago at all, the perceived risk was to be involved. Now it's actually becoming a totally different approach, attitude, where to not understand what's going on and to potentially not even have some exposure is maybe the more risky point of view. So we're seeing institutions that are really wanting to get involved. We spend hours and hours with teams looking at operational due diligence and understanding the asset class generally, and that's exciting. It's fun. So there's a huge amount of value to be added as these traditional managers look to diversify their portfolios properly. And there's been lots said around all of that as well. But I guess those are the exciting opportunities that we're seeing. No, it's really around all of that.
Avaneesh, do you want to give some color on that from your side, and then we can finish with Julien? And just a reminder to the audience, we've got about 4 minutes left, so if you do have any questions now, if you can add them into the chat, please.
Yeah, for the next 12 months, what I'm excited about the most is there's some real breadth to the market now. Obviously, Bitcoin has a very solid, strong, well understood use case as a store of value, and there's the macro tailwinds to support that at the moment. But then you've got the rest of the market, which has shown some real life, and you've got some real use case that's emerging from DeFi, from NFTs, and we're seeing like the first round, I would say, of like really usable decentralized apps. And so that I think that's the bit I'm most excited about. And obviously the use case really plays in what Martin was talking about with the base layer protocols, and we're already seeing Ethereum is extremely busy to the point of being congested at times. But this use case is something that's new. It wasn't there in the last cycle, and so that's what I'm looking forward to. It creates a lot of really interesting investment opportunities.
Yeah, I think for us it's more the off-exchange settlement, because for people doing a quant strategy like us, we need the inventory to be on the exchange, so you can we already talk about the market risk and how you don't leverage, and the system risk and how you have experience managing your system risk. But the counterparty risk, of course, you can trade on the top 2-3 exchanges that keep most of their inventory on cold storage and are highly profitable. But I think the most important is we've been pushing for more than a year with exchanges to make them realize that if they want to attract institutional money, they will have to develop the off-exchange settlement. They didn't really understand that because they were so focused on retail, but it's moving, it's coming, it's actually already implemented in one of the top exchanges. So I think within the next 6 months, I have hope that in order to trade quant strategy on the exchange, you will have the opportunity to have the inventory sitting in your regulated and insured custodian and still be able to trade on the exchange in the off-exchange settlement.
And perhaps the final question, just talking about your main investor types for your fund, is that across high net worths, is it family offices or institutions? Perhaps we can start with Bob and go clockwise to finish.
Joe, I touched on it briefly before. Up till quite recently, we've been really friends and family. It's been people who are known to us. It's a network we've all developed. We've got a combination of some grey-haired old guys in the team, all the way through to just out of teens programmers. So there's a broad network there. There has been people that we've known. The conversations we've been having with people for 3-4 years now have swung around, as I mentioned, and we're beginning to get more inquiry from people actually beginning to say, look, we do actually want to know more. So it's becoming more institutional conversations. But the portfolio today still is predominantly friends, family, maybe some small family offices and so on.
Yeah, we're pretty similar. We've been at this for 3 years, but the first, most of the first 2 years was really just getting the licenses and getting set up. So, proper operations 1 year, and it's primarily high net worth. But what I'm seeing is we're just starting to make that move into the institutions. We've got One Wealth platform invested. And then we've got a couple of others where we've already signed like agreements and working on some other distribution agreements. So I'm hoping to transition a business more onto the institutional side, but ultimately, yeah, to get things off the ground, it's been high net worths majority.
Yeah, for us it was a journey. It started off in 2016-17 with high net worth. Oftentimes people that worked in large family offices. In Fund 3, then, which we raised in 2018, principals of those family offices came in, and we have today some of the largest family offices in Hong Kong as our LPs. We have quite a global investor base. Quite frankly, we have really investors from all across the world, and corporates like Line, the messaging company, we were their first investment. So it's really family offices, corporates, and private high net worth individuals. Not so much yet the pension funds, but these are the kind of the conversations that we're starting to enter now.
Yeah, similar for us. I would say we started with friends and family, and we see a major shift in the last, I would say, 3-4 months, where we get in touch with many institutional, private bank, fund of fund, big hedge fund that wants to diversify their risk. So yeah, it's really shifting from high net worth individuals to institutional, and it's happening now.
Well, thank you so much, guys, for your input today and your time. It was very, very informative, and we want to thank you. Thank you, guys.
Thank you, Matt.
Good night.
Bye-bye.